And you're saying, they can't get no respect here. Why? What's happening?
Well, I think that there are very legitimate reasons why these stocks have sold off. You have to remember, it's not just that both of them missed first quarter expectations and lowered their guidance for the full year, but that was on top of already reduced guidance, right? So it's sort of like a double whammy. Having said that, these are very much cyclical issues. These are not secular issues. Specifically, inflation is still stubbornly high. And what that is doing is that's leading to stronger sales of consumable items, think food, health, beauty care items, and weaker sales of discretionary items, think seasonal items, and they make much higher profit margins on those discretionary items. But at the same time, they're still dealing with wage inflation and inflation throughout the supply chain. But like I said, these are cyclical headwinds. They're not secular ones.
But these stocks aren't acting well. And, you go back to Dollar Tree last week. You say, OK, they lowered their guidance and they cited shrink, among other things going on there as well. Maybe that would lower the bar for Dollar General, or maybe they were expected to benefit. But to have them back to back, two major declines tells you something's wrong with the whole sector, or something's wrong with the consumer, especially a day after Advance Auto, right? Like, is there some sort of sudden stop happening here where certain kinds of businesses are just being totally thrown for a loop in the past month or so?
I think really what we're seeing is, you have to remember, right, inflation is still stubbornly high. In the case of the dollar stores, also, income tax refunds were lower by about 10% in the U.S. And then you also had some increased SNAP benefits that went away. And so you're just seeing all of these headwinds. Now, the interesting thing is that their target customer, they are working. Inflation is actually much lower for blue collar workers than it is for more white collar ones. And they're seeing pretty significant wage growth, over the past couple of years, but it's just not enough, quite frankly. And to some extent, look, I'm not an economist. I'm not going to try to play one on TV. But to me, what this says is that the Fed has got to stop raising interest rates. Enough already. And quite frankly, I think that the Fed should consider lowering rates in late 2023, early 2024. Enough already.
I want to put you back on camera to have you repeat that, okay? Because and we hear from the Fed, they have the Beige book, they have things like this where they do want to hear from businesses. But what do you think is going to happen, that it just is going to take too long to show up in their data? Because they go, well, jobless claims were fine today. Tomorrow's unemployment print might be fine. Inflation's still higher than we want. So just, make the case.
Those are all backward-looking indicators, right? It's like, why was Wayne Gretzky so great? Because he didn't skate to where the puck was. He skated where the puck was going. And so I just think they've got to have some foresight here. Particularly given the fact that this string of, interest rate increases has been the fastest pace, I think, that anyone can really remember. And it really is having an impact. It's impacting consumer confidence. It's impacting, interest costs, right? One of the reasons that Dollar General's earnings were down was because they paid 15 cents a share more in interest expense. And that's because of higher interest rates. So they've got to look at the full picture, and they've also got to think about where the puck is going, not where the puck is right now.
So interesting. So let me ask you, I'll play devil's advocate to the argument that we're making and say, okay, well, what about Chewy? What about Nordstrom? What about Abercrombie? What about these pockets of strength, even among retail, that we are still seeing?
Well, the thing you have to remember is that, look, does the rising tide lift and lower all boats? Absolutely. But you always have to think about the company-specific issues. But like you said, Dollar Tree just had bad numbers. Dollar General is having bad numbers. Advance Auto Parts, train wreck. Foot Locker, train wreck. How many of these train wrecks do we have to see? So, look, I can't speak specifically to Chewy or those other companies. I don't cover those companies. But just because there are some outliers does not mean, what the Fed's doing is working great, because it's not. And we're seeing it in these numbers.
Quick final coda to all of this, because I just remembered we came into this saying, hey, maybe you should still buy the stock here. Why then buy the stock here? Why not wait for this kind of looming event and mistake that they're making to get more fully priced into these shares?
Very, very fair question. Look, a couple of things. First off, I think that trying to time the stock market, it's a loser's errand. It never really works. When you see a stock that is significantly off of recent highs and is trading at a valuation that's significantly lower than historical levels, probably a good time to buy that stock, assuming, like I said, that you think the fundamental story is still very much intact. The other thing is that, look, once the Fed starts starts lowering rates, these stocks are going to be off to the races. In other words, you're not going to have to necessarily wait for the fundamental improvement in the performance before the stocks start to work. So I would highly advise against trying to time these stocks.
All right, Anthony Chukumba with Loop Capital. Great to have you on today. Thank you so much.